Hi, this is Dr.S.VALLUVAN. Welcome to video number 3. The slide depicts the fundamental analysis. So these are the approaches under fundamental analysis: macroeconomic analysis, industry analysis, equity valuation model, financial statement analysis. We'll see one by one. In economic analysis, it involves assessing or examining topics or issues from an economist perspective. This allows investors to analyze the market from the big picture to all the way down to individual stocks. By examining the economic numbers, one can determine the current market strength and have a better idea of what the future holds. The key economic indicators investors must incorporate while selecting stocks. They are indices, that is indexes, Nifty 50 stocks, Nifty and Sensex. Then gross GDP, gross domestic products of a country, unemployment rate, inflation rate, consumer confidence, purchase managers index. Macroeconomic analysis. These are the macroeconomic factors which affect the market fluctuations. The global economic analysis affects export price competitions and profits, and foreign exchange rate, purchasing power and earnings, etc. Then come to domestic economy. The ability to forecast the macroeconomy can translate into a great investment performance, outperform the other analysts to earn extra profits. Many variables can affect the economy. GDP. It measures the economical total output of goods and services. Employment rate measures the extent that the company is operating at full capacity. Inflation measures the general level of price increases, flips curve. The interest rate, that will be looking at in detail about all this as we go along. Then interest rate, high interest rate reduces PV of cash flows, present value of cash flows, the stocks values. Budget deficit, large deficit means more borrowing, which implies higher interest rate. It's not good for the country as well as it's not good for the overall economy of the country. Sentiment, consumers and producers confidence. Business cycles, up and down, and stock returns are decreasing when at peak and increasing at trough. Cyclical industries do well in expansionary periods but poorly in recession periods. Example, durable goods such as automobile and washing machines, etc. Defensive industries, little sensitive to business cycles such as food, etc., etc. When move to industry analysis, selecting a good industry to invest. So an investor must look into the industries which performing good in all the time or at the period of time. It's difficult for a firm to do well in troubled industries. The Standard Industries Classifications Code, Value Line Investment Survey. Two factors that determine the sensitivity of the firm's earnings to business conditions. One is business risk and financial risk. These are the two factors which determine the company's earnings. Let's see what are they. Business risks, sales sensitivity to business conditions. Some industries are robust, that is food, while others are not. Example is movie. Then operating leverage, the division between the fixed and variable cost. Firms with greater amounts of variable cost relative to the fixed cost are subject less to business fluctuations. These profits are more stable. Then financial risk, the degree in using financial leverage, the more the company using a debt fund, the amount of interest payment, that is what we call financial risk. Leverage firm is more sensitive to business cycle. This slide depicts industry cycles: startup, build up, maturity and decline. So when you analyze the company within which the industry analysis also to be made, and he has to look after the industry cycle. Thank you.